Welcome to the Canadian Dividend Investing Podcast, an investing podcast by DIY investors for DIY investors. Join host Nelson Smith and guests as they discuss investing, business, and economics, all from a Canadian perspective. This podcast is meant for entertainment and research purposes only. Canadian Dividend Investing urges everyone listening to seek advice from a qualified professional before making any financial decisions. Enjoy the show.
Welcome to Canadian Dividend Investing. I am your host, Dividend Dave, and as always, with me is Nelson. This show will outline the advantages and disadvantages of investing solely in Canadian dividend-paying stocks. Nelson, are you ready to dive in?
Dave, I am so ready. And before we begin, for the people watching, this is the first episode that I've had Dave as the host. I think this is going to be terrific. I hope we have some nice back and forth, some banter, and maybe a little bit of challenging each other a little bit. You know, maybe we'll yell at each other and get mad. No, we probably won't. But,
no, we won't.
It'll be a good time, and I'm excited.
You may know me from other podcasts, including from The Simpsons, Troy McClure. You may know me from other, you may know me from the Passive Income podcast. And so, yes, thank you so much, Nelson, for inviting me here to help you with your podcast. This is going to be fun and exciting. And yeah, let's dive into the advantages and disadvantages of investing in Canadian dividend stocks. So I guess first up, what are the advantages of investing solely in Canadian dividend paying companies?
Well, there are a few. The big one is from a taxation perspective. If Canadian dividend income is your only source of income, then you can earn up to $75,000 per person tax-free. Now, again, that is if Canadian dividends are your sole source of income. But if they're not your sole source of income, they're still taxed quite attractive. So that for me is a big advantage. So the other advantages are Canada is a stable economy. It's filled with these oligarchy stocks, as I like to call them. So you look at our banks, our telecoms, our pipelines, our utilities, and they're just a handful of companies in each sector that dominate. And that tends to lead to competitive advantages, and it tends to end up in situations that are good for investors. Canada as a whole is a developed nation with a good rule of law, and it is a good place to put your money. And there's probably a couple other that I'm forgetting as right now that we'll get into as we go along.
Yeah. So just to sum up the advantages, you would say, solid companies with a history of good performance, backbone of the Canadian economy, the stability of a first world nation like Canada, and then the tax considerations can be attractive as well. So quite a few advantages right off the top.
That's a good summary.
Okay, let's talk about some of the disadvantages of investing in only Canadian dividend paying stocks.
So the first one, and this is the big one, is that there are lots of companies both inside of Canada and outside of Canada that are wonderful companies that don't pay dividends. A few off the top of my head, there's Tesla, there's Netflix, there's Amazon. It used to be Google and Facebook, but those have recently started paying small dividends. There are all sorts of companies around the world that are wonderful companies that don't pay dividends. And that's an issue for a lot of investors, and that is rightfully a disadvantage. Another disadvantage is that Canada is a sort of, on the surface, it looks like a very non-diversified, it's a very concentrated market. You look at the composition of the TSX, and you have a big weighting in financials, a big weighting in oil, a big weighting in gold. People look at that and they say, there's no way to build a diversified portfolio inside of Canada. I don't agree with that. We'll talk about that later. And another disadvantage is that in situations where, for instance, interest rates are going up, is there are a lot of Canadian stocks that will get hit because they are more of a play on interest rates. So we've got that there as well. It's a disadvantage.
Yeah, I definitely hear what you're saying about Canada being seen as less diverse and less tech stock. You mentioned the Teslas and Netflix and Amazons of the world and the Googles and Facebooks that, as you mentioned, the last two have recently started paying that small dividend, but more or less they're tech growth stocks. And Canada just does not have that, unless maybe if you count Shopify. I think that would probably be the only one that would even come close to falling into that category.
Yeah, you're right. Shopify's the big one. There are a couple others that, like I know Lightspeed is one that people were very excited about for a time, and I don't think it's done very well lately. Ultimately, what it comes down to is a lot of it is sort of return chasing. The Netflix, Teslas, et cetera, all these stocks have done incredibly well versus Canadian stocks.
Yeah.
That's a problem for investors looking for returns.
Yeah. Those total growth investors that want the big returns. And then just
Exactly.
the final couple points there on the disadvantages is you mentioned that you're betting on interest rates. And luckily we're starting to see the interest rates come down. Inflation seems to be getting under control finally after the last 3 or 4 years and having a really hard time at the grocery store. All of us going, what? A dozen eggs cost how much? Right? Like we've all been there.
Yeah, I was going to say, I was working in the grocery business during the big push in inflation. I witnessed that firsthand when I worked there, and it's a tough time to be a Canadian consumer for sure.
Okay, I have a lot of questions about both the advantages and disadvantages of investing solely in Canadian dividend paying companies. Let's break this down into the questions about advantages and then the ones about disadvantages. Does that sound good to you?
Sure, let's do it.
Okay, so we've already touched on this a little bit, talking about the Teslas of the world and the Amazons. And sort of, don't you give up entirely on the growth by buying these Canadian blue chips?
Buying Canadian blue chips is definitely a lower growth strategy versus buying the big tech companies. However, there are certain advantages to doing it that way. So large tech companies are very volatile. We saw that in 2022, where a lot of these stocks fell 50, 60, 70% from their highs. Now they did recover, but there are a lot of investors who they don't want that. They don't want that volatility. And the other disadvantage from my perspective is that those stocks either don't pay dividends or pay very small dividends. And for people whose goals include passive income, whether it's retiring on the passive income, whether it's using that passive income to pay bills, whatever, those kind of stocks are unattractive. So
Right.
ultimately, you are potentially giving up some upside. Like, these stocks have gone up for so long that people just assume they're going to keep going up. And I don't know if that's true or not, but the point is that dividends are more guaranteed. Upside is more speculative.
Right. Now, quite often here in Canada, we talk about these blue chips like your Bell Canadas and the rail, CP Rail and CN Rail and Enbridge and the other utilities and oil and gas companies being the backbone of the Canadian economy. And so my question, hasn't the last 10 years of Liberal government driven the Canadian economy to the worst we've seen in our lifetime?
You look at the economic numbers and there's no doubt that they're not great. You look at GDP per capita, it sort of keeps kind of grinding lower. The immigration kind of thesis is that all these people coming to Canada, it's going to be bullish for Canada. It's going to be bullish for Canadian stocks. It has only sort of played out. So I understand that from a perspective of like, hey, the economy hasn't been great lately, and it's easy to blame the guy in charge. I kind of view it as a more agnostic sort of perspective where it's like the economy stinks. Is it the guy in charge's fault? I don't know, but it kind of makes it more and more likely that a new guy will be in charge in about a year now, whatever the next election will be. And that change is probably going to be a good thing. Whether it's actually a good thing, I don't know. But from the perspective of the market, that the market will like it. And that's the important part.
Right. The market will like it. And to answer that, as we are recording today, it is exactly 365 days or less until the next Canadian election.
That's it. Who knows what'll happen
Yeah.
between now and then? The leader of the opposition sure would like it to be sooner.
Okay. So why not take more risks in the overall market or just overall in general, especially considering risk equals reward?
Risk doesn't equal reward, because if it did, then the value of the lottery would be massively positive for people. So I think that a lot of investors are making that mistake, is that risk equals reward. It does. Well, they're correlated. There's no doubt about that. Now saying that, being a little bit facetious here, because the question is more on these tech stocks are generally perceived to be riskier and they've done quite well. And that's true. There's no doubt about that. For me, I look at it and I say, I'm willing to take a little bit less risk. I want to protect my capital a little bit more in case if the market falls in, and I'm willing to take a little bit less return in order to accomplish that. Now, some people listening might not, and that's fine. They can do whatever they like. Just remember that this risk and reward it exists on a spectrum. They're not equally correlated to each other. There's a chance that some of these high risk investments will not work out and you'll lose your capital. And I think there's a much smaller chance of that happening when you invest in kind of boring blue chips.
Right. And speaking of boring blue chips, the likes of Enbridge, BCE, Bell Canada, Manulife, and so many others, do you consider those companies to really have wide moats or moats at all?
Oh, for sure they do. I think that, if I gave you $10 billion and told you to replace Enbridge's Line 3, which is the pipeline that goes from Alberta all the way to the oil refineries in Ontario through Michigan, that's the pipeline that Michigan dislikes. If I give you $10 billion and told you to replace it, I don't think you could do it. I got a lot of confidence in Dividend Dave here. I don't think you could do it. And I don't think you could replace a company like Manulife just with money. I don't think you could replace the Canadian banks just with money. And that's how I view moats, is that if I gave you a whole bunch of money, could you make, Royal Bank's life miserable? I think you could put a dent in Royal Bank, but I don't think that you would kill it.
I will tell you one thing. If you give me $10 billion, I am not building a pipeline. You will never see me again.
All right. Don't give Dave $10 billion.
Yeah, that's what we've all really learned here today. Don't give me $10 billion.
Dave's gone.
Well, wouldn't you be? Like, it's $10 million. I'd be on a Philippines or somewhere.
Those people who say, if I won $50 million at the lottery, it's like, I'd go back to work. Say, come on, like have a little bit of imagination, like you can do literally anything and you decide, I'm going to go back to work.
No, go travel the world, see everything you've ever wanted to see.
Exactly. Or just like be a golf bum or something.
Well, travel the world golfing. There you go.
That's it. Yeah. On a private jet. Why not?
Okay. Why do you insist on dividends when you can just sell shares whenever you need cash?
The dividend is steady, secure. The cash is good. And when it comes to selling shares, the shares move all the time and it's difficult to time a share sales. Like, I think that one of the biggest things for investors is the difficulty in knowing when to sell. It's incredibly difficult. I am not very good at it. And I've spent a lot of time thinking about it and trying to figure out kind of the best way to do it. And I think the average investor is really, really bad at it. And that's why I take kind of a buy and hold forever approach. I don't always do it. Obviously I invest in some stuff that doesn't work out, but I try to hold it forever because that takes away that sell question. I think a retirement strategy that is just collecting the dividends is far easier to implement than one that is, there's a portfolio of 30 stocks in it or 50 stocks in it, or however many stocks someone puts in their portfolio. Figure out which one to sell and figure out the percentage of which one to sell. I don't think that's a easy to replicate solution. So I advocate the simple one, which is just sit back, relax, collect your dividends, pay your dividends, and Bob's your uncle.
Right. Yeah. No, I agree with you. Obviously, I'm a little bit biased as well when it comes to dividends, but it's the easy, simple solution, in my opinion. Okay, taxes and the advantages that come with the dividend investing may be the biggest advantage of all of the advantages. Why is that?
So the way that the Canadian tax system works is that basically if you're a middle-class taxpayer that only collects dividends, the tax system is massively in your favor. You and your spouse can each earn $75,000 a year, approximately. And it depends on the province. Some provinces will pay a small amount of tax if you earn $75,000. But for the most part, you can earn $75,000 and your spouse can earn $75,000 tax-free, or very, very close. Very, very close to tax-free, $150,000 total family income. So for me, that is a massive advantage because that is I think a sort of a decent middle class kind of retirement for a lot of people, and they can do so while minimizing their taxes. Now, the naysayers are going to say, well, what about CPP? What about OAS? And, there are very few people who have no other income besides their dividends. And that's true. I'll admit that. But even if you include CPP, OAS, dividends are still taxed very attractively.
Right.
You're looking at under a 10% tax rate in total, depending on your income or whatever. As your income gets higher and higher, obviously you pay more taxes. But if you have a kind of a regular Canadian middle class retirement on dividends and a little bit of CPP and OAS, it will still be incredibly tax advantaged. And that's a big advantage for the average Canadian retiree that I don't think a lot of people fully understand.
Yeah, and just to sort of finalize that thought for anyone listening or watching on this episode who isn't sure, OAS is Old Age Security and CPP is the Canada Pension Plan.
Exactly. CPP is the one that you pay into for your entire working career, and OAS is basically welfare for seniors.
Yes,
They go to basically everyone, so it's not welfare. It's just,
exactly.
hey, you're old. You're old. Have some money.
Yeah, it's not very much money, but here's a little bit anyway. Okay, last question before we get into the disadvantages. Why do you think, or why do you feel dividend investing is the most business-like form of investing?
Sure. So when you own a business, how do you collect income from? How do you live on a business? And the answer is you just take some of the earnings every year and you pay yourself that as a dividend, and then you reinvest the rest into the company. So as a business owner, the idea of selling off 5% of your business every year to pay your bills, it just doesn't exist. You're not doing that. That's not what a business owner does. That's what I mean when I say that dividend investing is most business-like investing approach, because you are taking a long-term partnership with a business, and every year they pay back a portion of the profits to the shareholders, the owners. And that is much more business-like from my perspective than selling off shares every year and basically selling off your stake in the business every year. Business owners don't like to sell. I don't like to sell. I collect.
Okay. I know we've already touched on, as we're going to jump into some of my questions I have on disadvantages. We've already kind of touched on a lot of this as we went through the questions on advantages. So some of it just might be a bit of a re-summary or re-summarization. And okay, off the top, so TSX, the Toronto Stock Exchange, at first glance looks quite concentrated. Do you think that is just lazy analysis?
Yeah, I've harped on this a little bit on Twitter. I wrote about it in the newsletter as well. I really think that that's lazy analysis. And I'll tell you why. It's because you look at the top 20 names in the TSX, the Toronto Stock Exchange. So that's Royal Bank, that's TD Bank, Canadian National Railway, Canadian Pacific Railway. These are like the biggest, largest blue chips in Canada. So you put all those together and you get, I think it's a 50% weighting on the TSX. So people look at that and they say, well, Canada's only 3% of world GDP. You have these top 20 companies that are 50% of the Canadian market. It's not diversified. I'm not investing. So what you have to do at that point is you have to kind of look underneath the hood a little bit, and you have to say, okay, listen, I've got Royal Bank. What does Royal Bank consist of? Well, Royal Bank consists of a Canadian bank, a US bank, and a Caribbean bank. And the Canadian bank is approximately 60% of Royal Bank, and then the US bank is 20%, and Caribbean's 20%. They have a capital markets division on top of that too, which operates all around the world. But the point is that Royal Bank is not 100% Canadian. Royal Bank is 60%. And then you look at TD Bank, and TD Bank is about the same in terms of what 60% Canadian, 40% US. And you go down the list and you see like a company like Manulife. Manulife is expanding in Asia right now, and they're getting to a point where I think it's about 3 or 4 years from now, most of their business will come from Asia. So you put all these things together and you've got a market that is much more diversified than what it looks like at first glance. You've got big bets on the US market, Asian market, European markets to a certain extent. The other thing is that you can take the TSX and you go further down the list, and all of a sudden you've got companies like there's European Apartment REIT, which owns apartments in the Netherlands. There is DRI Healthcare Trust, ticker symbols DHT, that owns farmer royalties in the United States. And you just go down the list, and it's really not that hard to build a diversified portfolio in the TSX for stocks that have exposure in the United States, Asia, etc. So you put both those things together, and the TSX is much more diversified than what it perceives.
Yeah, exactly. You kind of already touched on the next question with that last answer, like with small and mid cap stocks helping the diversification problem. And I agree with you 100%. You just go down the list and you find some of those more attractive mid-sized and small cap stocks, and you can become very diversified just within the TSX.
That's the other thing is that Canada is sort of perceived as having a lot of boring, low growth stocks. And my perspective is that if you go further down the list and you look a little bit harder, you find stocks that are have higher growth and kind of operate in interesting niches that do have this kind of long-term growth potential.
Okay, now the biggest question in the disadvantages, which we already touched on in the advantages, but doesn't it bother you to miss out on the likes of Tesla, Amazon, Nvidia, Berkshire Hathaway, and more by avoiding these non-dividend payers altogether?
Yeah, the FOMO is certainly very real. And, for me, really, it came from kind of working backwards. So I worked from, okay, what's my goal here? If the goal was to live on the dividends and to have dividends cover my expenses, then from that perspective, it's like, okay, like I have to buy the stocks that let me achieve that goal. In doing so, I'm going to miss out on a certain amount of stocks. And I'm okay with that because it's like, hey, this is my goal. I'm working backwards from it. Now, there's some people whose goal is to end up with the largest amount of money, and that's it. And I found that for a lot of those people, it's a very admirable goal until we get a prolonged bear market, and then all of a sudden they freak out and they start making some suboptimal decisions because it's, you're slave to the market and in that sort of scenario. And if you continue to be a slave to the market, when the market doesn't cooperate, that's very tough to go through.
Yeah, those bear markets can be tough if your bear portfolio is based on or focused on total growth, because you're right. It's all of a sudden you're like, oh no, oh no. But through a bear market, if you have all these dividend payers, you just sit back and it keeps coming in. The risk of a dividend cut is always there, but more or less, those dividends keep rolling in.
Yeah, exactly. And, I don't care what type of investment sort of strategy you do. Bear markets are hard. They're
Right.
not the easiest thing to go through. And, dividends rolling in helps. And if you can sort of gain a behavioral advantage during bear markets by using dividends and by focusing on those dividends coming in, then that's a very good thing. Everyone talks about how they love a bear market. I take advantage of it. And I mean, I've been through a number of bear markets now. I'm old. I got gray in my beard. There's a lot of people that say I'm going to be smart during the next bear market. And I watched it, last year in Canada, like around this time last year, interest rates were going up and a lot of these Canadian interest sensitive stocks were falling hard. And lots of people in my mentions on Twitter were saying, I'm buying a GIC. I'm not taking any market risk. What are you doing buying TC pipelines here or Enbridge here?
Well, they're at 5-year lows. Why wouldn't I?
Exactly. And, the GICs for these people, yeah, they got their 5%, and that's not a terrible outcome, but they missed out on the subsequent run up. And that is, that's not an optimal decision. It's not a bad decision, but it wasn't an optimal decision.
I know you did sort of mention this here in the last answer, and sort of the Canadian dividend portfolio really isn't it just a bet on interest rates?
But that's a very valid criticism, actually. And you look at the high yield part of the Canadian blue chip market. So that's the Enbridge, TC, even like the telecoms and to the banks a little bit too. People call it factor investing, where you're just basically making a bet on interest rates. Is you mix in some Canadian dividend growth stocks in there with your kind of Canadian higher yield stocks. And so that's, company like Couche-Tard pays less than 1% yield. It's grown quite a bit. And, that stock sort of survived that bear market much better than the high yield stocks. Dollarama is another one. And you just go down the list, there's
Right.
all sorts of kind of Canadian stocks that do have growth that are expanded into the United States, other places, and they pay much lower dividends and much lower payout ratios. And those definitely are not a kind of a big play on interest rates. They're more of a big play on the economy. They will get hurt when kind of the overall market gets hurt next time. But in the meantime, they'll do well. And, ultimately it's like the stock goes down because the market makes it go down. Well, that's not really that big of the stock goes down because it's not executing, then that's the bigger.
Yeah, exactly. You mentioned Couche-Tard, ticker symbol ATD, and that's a very interesting case study. Like, owner of convenience stores, Circle K being the biggest chain I think, out of all of them. And yeah, people are going to go to convenience stores. They know that they're going to pay 50 cents more for a loaf of bread or $1 more for this or that at the convenience store, but that is the convenience of it, right? You're going to pay a little bit more for that convenience. And I mean, Circle K that chain is absolutely huge now. So jumping into the next question, dividend cuts, don't they throw this plan into total and complete chaos?
Obviously, a dividend cut is a bad thing. We want to avoid them as much as possible. And look, if you're a dividend investor, you're going to experience a dividend cut or two or three at some point. It's only a matter of time. That's an issue. But what do you think happens to the share price when a dividend gets cut? Because ultimately, a dividend gets cut because the underlying earnings won't support the dividend. So what happens to the share price in such a scenario? Well, it's very simple. It goes down, and it usually goes down a lot. And so if you look at retirement planning as either living off the dividends or selling shares to make sure you have enough money to eat, both of those scenarios work out badly. So it's like, yeah, a dividend might get cut, but in such a scenario that, your price of the underlying stock is also going to get hammered. So whatever your strategy was, it's going to work out badly. Now, the way to avoid dividend cuts being a big issue for your entire portfolio is very simple. It's diversification. And whether it's 20 different stocks, whether it's 50 different stocks, whether it's an ETF, ultimately that is what will protect you from one or two dividend cuts. And, they're a fact of life, but you can take steps to minimize them.
Right. Now we've talked all about Canadian dividend. What about mixing in some US companies that pay a dividend?
Nothing wrong with that. I do have about, I think for me, it's about 15% of my portfolio in the US. And I want to increase that over time because a lot of the world's best companies trade on the US markets. There's no doubt about that. I have no issue with anyone listening saying, I'm going to mix in whatever percentage of US dividend stocks. I mean, even go to 100%, like that. I see the logic in that, like it's a wonderful market. They have worldwide diversification, so on and so on. There's a lot of advantages to investing in US stocks. Just remember that from a Canadian perspective, we have one disadvantage, and that is that taxation on US dividends is not nearly as attractive as taxation on Canadian dividends. And if you go down that route, you will end up paying more in taxes. Now, that might be a fine trade-off for some people, and a dividend-focused investing strategy will generally get you a very low tax bill versus earning that as a employee or from interest or any of the other kind of sources of income. So ultimately, it's not a bad strategy if you want to do it. It's just you're giving up some of that taxation advantage.
Okay, last question. What do you say to people who say things like living off the dividends isn't a financial plan or similar arguments?
So one is that, I found that these arguments is more of a, I don't like this financial plan, therefore it's bad. And I think that ultimately living on the dividends is a good start to a financial plan. You have to, of course, keep in mind the other things in terms of, when are you going to withdraw from your RSP, all these other kind of questions that come up. But if you have this northern light, this guiding light of, I'm just going to spend the dividends. I don't have to worry about withdrawal strategy. I don't have to worry about selling. I don't have to worry about all these things that investors worry about and that, they use to kind of overcomplicate their lives. Then I think that's a great basis for a financial plan. It keeps you like motivated, and it just keeps things simple, and simple plans have a much smaller chance of kind of going all haywire versus more complicated plans.
Yeah. And that can be said for almost anything in life, right? Just the kiss, keep it simple, stupid. As opposed to overcomplicating anything. All right, Nelson, before we sign off, do you have anything else you would like to add?
I thought it was a great show. Dave, thanks for your debut as host. We will see everyone next week.
Thanks for listening. Canadian Dividend Investing is a reader-supported publication. If you'd like to support the podcast, please upgrade to our premium membership option, which includes early access to episodes, 2 pieces of exclusive research each week, visibility into Nelson's portfolio, and much more. Visit CanadianDividendInvesting.com for more details.